Hi, I'm Rachel Bubb. I'm a certified financial planner at KW Wealth. Today I'm with Chris Bertarelli from John Hancock, and we're going to talk about how different emotions and biases can influence an investor's behavior. So finance has been based off of two assumptions. One, that markets are efficient and act in predictable manners. And two, investors are rational and make decisions using all available information. Well, what we've discovered is that's not actually the case. Investors are making more decisions based on their emotions, biases, and cognitive errors, and it's ultimately leading to some poor decisions that can impact your long-term financial plan. So let's talk about some of the biases and give you some actionable tips as how to remedy it and make sure that your long-term financial plan is healthy and you're that rational investor that the market is assuming. So Chris, go ahead and take it away.
Thank you, Rachel. It's a pleasure to be here. So yeah, let's dive into anchoring. Anchoring is how well you concentrate and focus. Now that's a good thing if you have a task that's really complex. It allows you to concentrate and focus on coming up with a solution or a remedy to whatever you're working on. So that's a good thing. It's a bad thing if you concentrate and focus too heavily on one factor and don't consider other issues that could influence the eventual outcome. So this is a great example. So in the 70s, we had a really bad recession, right? So we had the end of the Vietnam War that didn't go well. We had a president that was forced to resign. That wasn't great. We had an oil embargo. We had really high inflation. I mean, we've had inflation that's high recently, but it was much higher in the 70s. And so we went into recession. A lot of people got laid off. The stock market went down. In fact, the stock market from peak to trough went down about 47%. And in fact, if you just anchored and focused on this one episode in time, you may decide you're never going to invest in the stock market. You're never going to invest in individual companies, right? But instead, if we kind of broaden our perspective, we think over a longer period of time, what we understand is, that that's just really kind of a blip on the radar and really not worth concentrating and anchoring too much on. In fact, as I look at this chart, so what you're looking at is the growth of the S&P 500, which is basically the 500 largest companies in the United States. And you can see the exponential growth over that period dating back to 1970. But what I like to point out are a couple of periods that happened during the decade of the 2000s, right? So we had a lot of people remember, I remember because I've been around a long time, but you remember the dot-com bubble that burst, right? Y2K, all of our computers were going to stop working. And then shortly after that, we had 9/11 tragic period on our history. Peak to trough, the market went down about 48%. And of course, the global financial crisis that occurred beginning in October of 2007, the market went down about 56% peak to trough. And I think about those two periods and I look at this chart and I think to myself, wow, what a great opportunity to invest more. I mean, what you were reading in the newspaper, what you're hearing on the radio and on TV wasn't great news, but the reality is, volatility creates opportunity. And I think this helps to illustrate that. We can look at it a couple of different ways too. I like to tell people, expect that, there'll be 3 up years and 1 down year. Just that's what's going to happen. Just get that in your head, accept it. It's not a big deal. So, bear markets happen. It's not the end of the world. But if you think long term, if we instead look at this chart a different way, so this looks at the number of positive years and negative years, going back to 1928. We look over at 10-year periods, right? Because when we invest in stocks, it's usually because we have a long time horizon. And everyone should have a really long time horizon. Even if you're 65, when you think about it, there's a married couple 65, there's a 50% chance that one spouse will live to age 90. That's 25 years in retirement. That's a great time horizon for equity. But if we look at it over 10-year periods, look at that. Instead of being, 1 down year, 3 up years, basically 94% of rolling 10-year periods, the stock market had a positive result. And so this is for further evidence that thinking long term is a good way to go. So if you think to yourself, or say something like this out loud, chances are the influence of this bias. I'm still down 10%. I just want to get back to where I started. That's really not relevant, right? Because you're thinking over the long period, right? You're focusing on a percentage. Your account's going to fluctuate. It's going to be up some days, it's going to be down some days. It's not a big deal. As long as you have a long-term time horizon. Or 6 months ago, I had X and now I have half that much. It's not a percentage, it's really more of a dollar amount, but the same paradigm's true, right? You're not focusing on your long-term goals. And so it's not, it's really not relevant unless I need the money today, right? I've got a goal, but if you have a financial plan, if you have a short-term goal, your investments will kind of reflect that. You'll have short-term investments for short-term goals and that type of thing. So what should you do about it if you find yourself under the influence of this bias? Well, the first one is, try to keep an open mind, right? There are several factors that are going to lead to an outcome. Seek out information to give you perspective and change your anchors. I've got, for those three bullets, I've got one example that's, pretty fresh in everybody's mind that I hope will help everybody understand. But, early in the COVID crisis, right? So from February 19th to March 23rd, the market went down about 33%. It was the quickest bear market in history. And, we're all getting locked down. I remember my last day in the field working with clients was on March 12th. And we didn't have a vaccine at that point and everybody was panicking, right? The economy is going to shut down. What's going to happen to my investments? And that's why the market went down so much. But there were two factors that have a big influence on what eventually happened. And basically, what I'm talking about is the massive fiscal and monetary stimulus that occurred. Right, it was unprecedented size and scope, and those are two big factors that had a big influence on the outcome. And a lot of people, sadly, they didn't really see it. The market went down, they panicked, they went to cash, and then when the market rebounded, it rebounded really quickly. Sadly, they were left behind, and it could take them years to catch up. And then let progress toward your goals be the benchmark. The rate of return on the Dow Jones Industrial Average, the S&P 500, the MSCI EV, all of these indices that people track is irrelevant. What's important is based on how much capital I have right now and how much I can save if I'm still in the accumulation phase, or how much I'm spending if I'm retired, right? What rate of return do I need in order for me to reach my goal? That number, if it's 5%, 6%, 7%, whatever that number is, that's the most relevant number that you want to track. And when you do a financial plan, your financial advisor can give you a sense for what that number looks like. And that is the number you want to track.
Yeah, anchoring can be a problem. I've had several clients come in and they tell me what their portfolio value was at a certain time and are benchmarking that for their future decisions. And that can really impact the decision that you're making today and influence a long-term financial plan. So Chris is right. Talk to your advisor. Anchor on that number that you need as a return, as opposed to the number in your portfolio if you choose to anchor on something. But I just encourage you not to anchor at all if you can avoid it. And I loved what you said too about volatility is opportunity. So as we think forward about some of the things that you can do to help remedy anchoring or some of these other biases, remember, write down your financial plan. You and your advisor created that together. It's based on you. It's personal, what your goals and your visions are. And make sure you're benchmarking your progress towards your goals. And then 2, identify the steps that'll help you recover when you start to feel yourself anchoring or in any bias. So what do you need to do? Do you need to go for a walk? Do you need to call your financial advisor? Figure out something that can help you recover. And then 3, set those realistic expectations. So we've talked about it. The market's going to go up and it's also going to go down. More often than not, though, it's going up. So just remember that in those times where it feels like, wow, this is the worst time in the world. And then 3, use that approach of dollar cost averaging or adding into the market over time. Remember what Chris said, volatility is opportunity. So if you've got a strategy where you're saving a little bit into the market every time, you're going to capture that opportunity. And then lastly, meet with your advisor annually. We are here to help you, be your coach, be alongside you in this journey. And if we can stick to this long-term plan together, we're both going to be better off. You're going to live out your vision and your dreams and your goals. And that's what we want. That's what we call financial success.